Welcome back. In this video, we're going to cover the challenge exercises for Chapter 10. As a sales manager, Hank Short was given the following static budget report for selling expenses in the winter sports department of Jennings Outdoor Company for the month of November. So we have our budget report for the month ended November 30th. We have the budget column that has the sales in units, the variable expenses, the fixed expenses, total expenses. Then we have the actual column, and then the differences in whether they're favorable or unfavorable. So we see we sold more than we budgeted, 4,500 units versus 4,000 units budgeted, but most of our variable expenses are unfavorable. The demo models given out was favorable. It's the only item, variable expenses that are favorable. Fixed expenses, there's no variances except for the depreciation on the vans, and the instructions indicated that that was because of a purchase of a new van because of an accident. So as a result of this budget, Hank was called into the president's office and congratulated on his fine sales performance. Sold more than budget. He was reprimanded, however, for allowing the cost to get out of control. Hank knew something was wrong with the performance report that he had been given. However, he was not sure what to do, and he comes to you for advice. So what we're going to do is create a budget report based on a flexible budget that we learned about in Chapter 10, see what happens there, then determine should Hank have been reprimanded and explain why or why not. And then we'll look at something to go into December with. So we're going to create the flexible budget report. So we're going to start with looking at our variable expenses on a per unit basis. So we're going to use the data from that first report in the budget. We had 4,000 units budgeted. We had the variable expenses in total. We take those total costs divided by 4,000 units, and we get our per unit budgeted amount. Once we have that, we can create the budget at 4,500 units because that's what our actual was at, 4,500, and that'll give us zero budget in the number of sales units. So we're going to be at the same budget, the unit level, and then compare costs based on that. So to get the budgeted expenses, we're going to take the per unit cost for the variable expenses times the new budget level of 4,500 units, and then we keep the fixed expenses the same. They're fixed. It's not going to change with our change in volume. So we see our total expenses are $608,375. Then for the actuals, we're going to have the same actuals we saw in the other budget report. The total $572,625. And then we can compare each line to see which items were favorable or unfavorable. So when we do that, we see that all of our variable expenses were actually favorable. So on a same level of activity, in this case unit sales, we actually controlled our variable expenses in each category because they're all favorable when we're at the same level. Fixed expenses, again, the depreciation on the van because we had a new van is the unfavorable amount. So our total expenses are favorable, $35,750. So the second question asked, should Hank have been reprimanded? And the answer is no, he should not have been. When we use the flexible budget report, Hank did manage the expenses. He came under budget in all levels except for the depreciation. And again, since we had the new auto, that was the explanation for that. Now Hank became familiar with the flexible budget report. He began to analyze the numbers. He feels that he sales can be increased if Jennings Outdoor Company would increase sales commissions to $31 per unit. This would allow them to reduce advertising expense to $8 per unit. Hank thinks that these changes will motivate the sales staff to sell at least 5,500 units, so an additional 1,000 units. And he is allowed to try this plan in December and had the following results. So let's go back for a second. Our sales commissions in November were $30 per unit. Our advertising expense was $9.50 per unit. So he's proposing to increase sales commissions $1 per unit and reduce advertising expense to $8, which would save $1.50 per unit. He thinks that's going to increase the sales by 1,000 units. Here's what happened. They did sell the 5,500 units. We had the dollar amounts for variable expenses and then for fixed expenses as well. So we incurred $679,500 in expenses. Now we're going to prepare the budget report for December based on the flexible budget data. So we're going to use the same or the new per unit $31 for sales commissions, $8 for advertising. The other two will be the same. We're going to do that for 5,500 units. And now that it's the next month, we know that the depreciation is higher, so we're going to include that higher depreciation amount in the budget amount. And then we'll see if that new plan is valid. So here's what it looks like. We have the budget column at 5,500 units. The new per unit basis for sales commissions and advertising expenses. Travel expense and demo models given out are the same per unit that we saw before. That gives us $606,375 of variable expenses at 5,500 units. Our actuals came in at 569,000, so we were favorable, $37,375. And our fixed expenses were all on budget, no variances in our fixed expenses. So we were favorable to our flexible budget at 5,500 units by the total of 37,375. So based on this, yeah, his plan worked. They increased sales, and he was still able to control costs, and we were favorable on our expenses by $37,000. Problem 2, the camping division of Custer Company is operated as a profit center. Sales for the division were budgeted for 2020 at $700,000. The only variable costs budgeted for the division were cost of goods sold, $340,000, and selling and administrative, $46,000. Fixed costs were budgeted at $77,000 for cost of goods sold and $70,000 for selling and administrative, and $69,000 for non-controllable fixed costs. Here were the actual results. We had sales $678,000, variable and fixed cost of goods sold, and variable and fixed selling and administrative. So remember, when we're looking at a profit center, we're going to be looking at sales minus the controllable costs. So we're going to take all these costs into account except for the non-controllable fixed costs. And we're going to prepare that responsibility report for the camping division. Then we will look at what if the division was a investment center, bring in our non-controllable fixed costs because it's controllable at the investment center level, and then we'll compute the ROI. So the first thing we do is the responsibility report for the camping division for 2020. So we have our budgeted data on the left there, $700,000 of sales. We We subtract our variable costs, both cost of goods sold and selling and administrative, total variable costs. Then we subtract that from our sales and we get our contribution margin. Then we subtract our controllable fixed costs, both cost of goods sold and selling and administrative, and that gives us our controllable margin. So we budgeted $700,000 of sales and $167,000 of controllable margin. Our actuals for the month came in at $678,000. So we are unfavorable on sales, $22,000. We sold less than we'd budgeted. Our contribution margin, however, is actually higher than our budgeted by $2,000 because our cost of goods, our variable costs, cost of goods sold and selling and administrative variable, were $24,000 less, so $24,000 favorable than what we had budgeted. So unfavorable sales, but favorable variable cost gives us a favorable contribution margin. If we look at our fixed costs, cost of goods sold was unfavorable, $4,000. Selling and administrative fixed costs were favorable, $19,000, so we were $15,000 favorable in total of fixed costs, $2,000 favorable in our contribution margin, so our controllable margin was favorable, $17,000. So even though we fell short of our sales target, our actual sales were less than our budgeted sales, we did a good job controlling our costs and were able to come in with a favorable controllable margin. The next question asked, what if we were a investment center? So now we're going to pull in our non-controllable fixed costs, which is uncontrollable at the profit center level, but at the investment center level, it is controllable, so we'll include that. So we take our controllable margins from the budget report at a profit center level, subtract that, what we called non-controllable fixed costs, which is now controllable at the investment center level, and we get our investment center controllable margin, $98,000 budget, $115,000 actual. Now we can calculate our return on investment, and we'll do that for both the budget and actual. To get return on investment, we take the controllable margin divided by the average operating assets, so $1 million in this case. So the $98,000 divided by $1 million, 9.8% budget. Actual, $115,000 controllable margin divided by the $1 million is 11.5%. Upon further analysis, Custer Company determined that if it committed to a 12-month advertising campaign costing $18,000, they could increase budgeted sales by 25%. Variable cost will also increase by 25%. Makes sense. Variable, it's going to go in, it's going to change and increase with the increase in sales. Fixed cost of goods sold will remain at $77,000. Selling and administrative expenses increased by the $18,000 cost of this contract to a total of $88,000. Non-controllable fixed costs would remain at $69,000. So here's what the budget amounts would be if we were to implement this. So we're going to prepare the responsibility report for camping division based on the new projections. Did the increase in advertising benefit the company? And then again, assume they were an investment center with average operating assets of $1 million. Controllable. The non-controllable fixed costs are now controllable at the investment center, so we'll subtract that to get a new controllable margin and compute the ROI and what happened with that change. So our report looks like this. Our budget was $875,000. Controllable margin budgeted was $227,500. So again, we increased our sales by 25%. Contribution margin, our variable costs were increased by 25% as well. So we have a new contribution margin. And our selling administrative fixed cost increased to $88,000 because of the planned advertising campaign. So our controllable margin budget is $227,500. Our actuals, we didn't quite sell the full amount, so we were $2,000 unfavorable. Cost of goods sold and selling administrative variable costs came in at a total of $476,000, which was favorable to budget by $6,500. So our contribution margin is favorable, $4,500. And our controllable fixed costs, cost of goods sold was unfavorable, $4,000, but our selling administrative was favorable, $17,000. So we were $13,000 favorable in total fixed, and our total controllable margin was favorable, $17,500. So with this new advertising campaign, it appears that yes, it is better to go ahead with that because we still remain favorable. We increase our sales and increase our margin. Now, if we go to investment center level, we're going to subtract our non-controllable fixed costs, $69,000 in both budget and actual, and we have our investment center controllable margins. Then we can calculate our return on investment. ROI budgeted goes to 15.9%, actual 17.6%. And the return on investment improved 6.1%. It went from 11.5% in the old version to 17.6%. So the additional advertising was a good idea and profitable to the company. So that's how you would think through and look at the flexible budget versus a static budget, and then looking at a profit center versus a investment center. With the investment center, you can include the return on investment calculation and look at that versus budget, and then look at that when you change some assumptions in the budget, in this case an advertising campaign, which would increase the sales. That's it for the challenge exercises. As usual, reach out if you have any questions. Thank you.